Before we dive in, quick but important note. Everything in this video is for educational purposes only. I am not a licensed financial advisor, and nothing here constitutes financial advice. Always conduct your own research and speak with a qualified professional before making any investment decisions. With that said, let's talk about one of the biggest market events of our lifetime. History was just made. On June 12, 2026, SpaceX became a publicly traded company in what is reportedly the largest IPO Wall Street has ever seen. And if you missed the opening bell, don't panic. You can still own shares with as little as $5. Most people think they've missed the boat. They see that roughly 20% first day move from $135 to around $160 and assume the opportunity is gone. I'm going to show you why that thinking may be wrong right now. In 2026, there are 6 legitimate ways to invest in SpaceX with $1,000 or less. 3 of them let you start with less than $50. The financial media is obsessed with who got IPO allocations and who got rich on day one. But nobody is telling you the practical part. How to actually buy shares today, how to think about entry timing, and what critical dates are coming up in the next 15 days. Today, I'm breaking down every pathway to SpaceX ownership now that it's trading under ticker symbol SPCX on Nasdaq, from $5 all the way up to more advanced strategies, plus the key dates you need to watch. Here's what matters. According to market data, SpaceX is now valued at over $2 trillion, making it one of the largest public companies on Earth. The IPO reportedly raised $75 billion. This is real market history, and I want to help you understand your options. By the end of this video, you'll know exactly which method fits your budget, how to think about entry timing, and what to watch for over the coming weeks. Let's get into it. First, let's talk about what actually happened. The details matter for how you think about your strategy going forward. According to public filings and news reports, SpaceX priced at $135 per share to raise approximately $75 billion, reportedly the largest capital raise in Wall Street history. The stock opened on June 12 at $150, about 11% above the IPO price, and closed its first trading day at $160.95 according to market data. A significant first-day move by any measure. That opening pushed the company's market capitalization above $2 trillion based on shares outstanding. Elon Musk, who reportedly holds a substantial ownership stake, saw his net worth rise considerably, though exact figures vary by source. The ticker symbol is SPCX, trading on Nasdaq with a dual listing on Nasdaq Texas. Demand was reportedly very strong, with the offering oversubscribed multiple times. Now, here's something important to understand about what you're actually investing in. This isn't just a rocket company. In early 2026, SpaceX completed an acquisition of Xi, folding artificial intelligence capabilities into the SpaceX business. According to public reporting, the stated strategy involves orbital AI infrastructure, high-altitude satellite networks designed to support computing workloads. A portion of IPO proceeds was reportedly used to pay off bridge financing from that acquisition, with the remainder earmarked for next-generation satellites and the Starship program. So when you invest in SpaceX today, understand the thesis. Wall Street is pricing in aerospace plus artificial intelligence infrastructure. That's a much bigger story than rockets alone. Welcome to Prosperity Levels. I'm Kevin. Today, I want to make the case for why missing the IPO price doesn't necessarily mean you miss the opportunity. If you believe in the long-term trajectory of this company, let's look at history. Missing an IPO price has often meant very little over the long term. Amazon IPO'd at $18 in 1997 and opened higher. Long-term holders who bought above the IPO price still saw extraordinary returns if they held for a decade or more. Google IPO'd at $85 in 2004 and opened around $100. Investors who bought after the IPO and held long-term still saw substantial gains over time. Tesla IPO'd at $17 in 2010, opened at $19. The small difference between IPO price and first day open meant nothing to long-term holders. What mattered was the company's trajectory over years, not days. I want to be clear, past performance does not guarantee future results. These aren't comparisons that predict SpaceX's future. They're simply examples showing that buying slightly above an IPO price is rarely the most important variable for long-term investors. What actually matters for long-term returns is the company's fundamental trajectory, competitive position, revenue growth, and execution. According to SpaceX's S-1 filing, the company generates significant revenue from launch services, Starlink subscriptions, and government contracts. If you believe in SpaceX's long-term trajectory, then buying at $160 versus $135 may matter less than you think over a 3, 5, or 10-year horizon. That said, this is your money, and only you can make that call. There are also two market dynamics coming in the next 15 days that are worth understanding before you decide when and how to buy. Let's cover those now. Before we discuss methods, you need to understand two timelines that could affect the stock price in the short term. Timeline 1. The anti-flipping window. Many major brokerages implement tracking on IPO allocations. Investors who received shares at the IPO price of $135 may face penalties or restrictions if they sell within a set window, often around 15 days. This varies by brokerage. What this could mean for you around day 16, approximately June 27th, some of those restrictions may lift. Investors sitting on first-day gains might choose to take profits. This could create temporary selling pressure and a short-term price dip, or it might not happen at all. Timeline 2. Index inclusion. This is potentially more significant. SpaceX may be fast-tracked into major indices, including the FTSE Russell and eventually the Nasdaq 100. Index eligibility typically requires a certain number of trading days, so watch for announcements in the coming weeks. Why does index inclusion matter? When a stock is added to a major index, passive index funds and retirement accounts that track that index are required to buy shares regardless of price. That's forced institutional buying pressure, potentially worth billions of dollars. So here's one possible scenario. Between late June and early July, you could see temporary selling pressure from early investors taking profits, followed by large-scale institutional buying from index funds. That gap could be a strategic entry window. It's not guaranteed, but it's a pattern worth watching. Now, let's break down the 6 methods for buying SpaceX at any budget level. Method 1 is the simplest approach. Buy shares directly through any major brokerage at current market price. The minimum investment depends on the share price and whether your broker offers fractional shares. At around $160 per share, you could buy one full share for roughly that amount, or as little as $5 to $10 with fractional shares at most modern brokerages. The process is straightforward. Open your Fidelity, Schwab, Robinhood, or Webull account. Search the ticker SPCX. Enter your dollar amount. Review and confirm. Done. You can own SpaceX in minutes. The main advantage here is simplicity. No special qualifications, no waiting periods, no complex strategies. You buy, you own, you hold. The trade-off is that you're buying at current market price, which reflects the first-day move higher. You missed the IPO entry at 135, and you're buying during a period of elevated attention and potentially elevated volatility. Whether that matters depends entirely on your time horizon. If you plan to hold for 5 to 10 years, entry price differences of $20 or $30 may be noise. If you're looking to trade short term, the entry price matters considerably more. This method works best if you want maximum simplicity, are comfortable with current prices, or are dollar cost averaging over time and aren't focused on timing a specific entry. Method 2 is particularly relevant for smaller investors. Fractional share purchasing allows you to own a portion of a share for any dollar amount you choose. As of 2026, Fidelity, Schwab, Robinhood, Webull, and most major brokers offer fractional shares down to $1 increments. Here's what this means practically. If SpaceX is trading at $160 and you have $50 to invest, you buy roughly 0.31 shares. $10, about 0.06 shares. The point is you're in the game regardless of share price. The main advantage is accessibility. You can own SpaceX at literally any price point. This makes dollar cost averaging highly practical. Investing a set amount every week or month regardless of price fluctuations. There are a couple of limitations worth knowing. Some brokerages don't grant voting rights on fractional shares, and fractional shares typically can't be transferred between brokers. You need to sell and repurchase. For most long-term investors, these are minor considerations. Real-world example. You invest $50 per week starting now. Over 12 months, that's roughly $2,600. Deployed gradually, building your position systematically across different price points. This method is ideal if you have limited capital, want to build positions gradually, or simply value the discipline of consistent investing over trying to time the market. Method 3 requires patience. The idea is to wait for a potential price dip before buying, particularly around the anti-flipping window we discussed. The logic: if early IPO holders take profits around June 27th, when restrictions ease, there could be temporary selling pressure that briefly pushes the price lower. That could be a more attractive entry point than buying at peak first week excitement. How to execute: set a price alert on SPCX for a level below current trading, say $145 to $150. Have your cash funded in your brokerage account right now, not next week. When and if that alert fires, you're ready to act. The key risk with this approach: the dip might not come. Index fund buying pressure could more than offset any selling, and the stock could continue higher while you wait. You could miss out on gains trying to save $10 or $15 per share. This is the classic investing dilemma: time in the market versus timing the market. Research generally favors time in the market for long-term investors, but strategic entry for a portion of your position is a reasonable approach. One balanced strategy: if you have $1,000 to invest, deploy half now and hold the other half ready to deploy if a dip materializes before mid-July. This way, you participate in any continued upside while maintaining dry powder for a potentially better entry. This method works best if you're disciplined, can handle the psychological pressure of watching the stock potentially run without you, and are thinking about entry price as part of a long-term position building strategy. Method 4 provides instant diversification across the space industry. Space-focused ETFs are actively adding or expected to add SpaceX as a significant holding now that it's publicly traded. Key options to research: ARK Space Exploration ETF ARKS, Procure Space ETF UFO, SPDR, Kensho Final Frontiers ETF ROCT, and broader aerospace funds like the iShares Aerospace and Defense ETF ITA. Always check current holdings before buying. Allocations change. How it works: you buy ETF shares today. As the fund managers rebalance and add SpaceX to their portfolios, you gain proportional indirect exposure to SPCX along with exposure to other space-related companies in the fund. Example: if ARKS allocates 10% of its portfolio to SpaceX and you own $1,000 of ARKS, you have roughly $100 of indirect SpaceX exposure plus diversification across Rocket Lab, satellite companies, and other space-adjacent businesses. The main advantage is diversification. You're not betting entirely on one company's execution. If SpaceX stumbles but other space companies thrive, your ETF position may hold up better than a concentrated individual stock position. The trade-off is diluted upside. If SpaceX doubles but represents 10% of the fund, your gain from that position is roughly 10%, not 100%. You also pay annual expense ratios, typically around 0.75% for funds like ARKS and UFO. This method works best if you want broad space industry exposure, prefer passive or semi-passive investing, value diversification over concentrated bets, or are building thematic allocations across a portfolio. Method 5 enters more sophisticated territory: options trading on SPCX. This is absolutely not for beginners, but I want to cover it because it's a legitimate strategy for experienced traders. Options on newly public stocks typically become available 7 to 15 trading days after IPO. For SpaceX, expect options to potentially open around late June, though check with your broker for confirmation. For bullish investors with options experience, buying call options gives you the right to purchase shares at a set price before a certain date. This provides leveraged exposure to price appreciation. If the stock moves in your favor significantly, your percentage gains can be higher than owning shares outright. If it doesn't, you can lose the entire premium you paid. A more conservative options approach: selling cash-secured puts. This means you're willing to buy shares at a lower price than current market, and you collect premium income while you wait. If the stock stays above your strike price, you keep the premium. If it falls below, you buy the shares, which is what you wanted anyway at that price. Serious caution: options are complex financial instruments. Implied volatility on a newly public, high-profile stock like SpaceX will likely be extremely elevated, making options expensive. Don't touch these unless you genuinely understand how they work and can afford to lose your entire premium. This method only makes sense for experienced options traders with a clear strategy, proper risk management, and the capital to absorb losses. Method 6 is buying on margin, borrowing money from your broker to purchase more shares than your cash alone would allow. This is a real strategy that experienced investors use, but it carries significant additional risk. How it works: you have $1,000 in cash. Your broker may allow you to borrow additional funds, often up to 50% of the position value for established stocks, though new IPOs may have stricter initial margin requirements. You effectively control a larger position than your cash alone supports. The upside amplification: if the stock rises 20% on a $2,000 position funded partly by margin, your gain is calculated on the full position, but your cash outlay was only $1,000. Returns on equity are amplified. The downside amplification: if the stock drops 20%, you lose 20% on the full position, not just your cash. On a $2,000 position where you put in $1,000, a 20% drop wipes out 40% of your actual cash invested. The margin call risk: if the stock drops significantly, your broker may issue a margin call requiring you to deposit more cash immediately, or they will automatically sell your shares at market price, potentially locking in losses at the worst possible moment. My honest recommendation: don't use margin for IPO stocks unless you're an experienced trader with substantial capital reserves and a disciplined risk management system. For most people watching this video, margin on a volatile new IPO is a fast track to painful losses. Let me give you a quick reference so you can decide which method or combination of methods fits your situation. Method 1: direct stock purchase. Minimum around $160 for one full share. $5 with fractional. Easiest access. Best for simplicity and immediate ownership at current prices. Method 2: fractional shares. Minimum $1. Equally easy access. Best for small investors and those who want to dollar cost average regardless of share price. Method 3: strategic entry timing. Minimum whatever your total budget is, held as cash. Requires patience and discipline. Target: a potential dip to 140150 if it materializes. Best for patient investors focused on entry price optimization. Method 4: space ETFs. Minimum 5100 typically. Very easy access. Provides indirect exposure. Best for investors who want diversified space sector exposure rather than a concentrated single stock bet. Method 5: options strategies. Minimum varies, typically 200,500 per contract. Requires options approval and genuine knowledge. Best for experienced options traders only. High risk. Method 6: margin buying. Minimum depends on broker. Requires margin approval. Amplifies both gains and losses. Best for experienced investors with high risk tolerance and strong risk management. Not recommended for most people. Your best choice depends on your available capital, risk tolerance, experience level, and time horizon. There's no single right answer, only what fits your personal situation. Let me walk through a realistic example. Meet Marcus, 34 years old, earns $75,000 annually, has $3,000 specifically set aside for SpaceX. He missed the IPO allocation. The stock is trading at $162, and he's wondering what to do. Remember, this is a hypothetical example for educational purposes. It's not a personalized recommendation for Marcus or for you. One possible approach for Marcus: deploy $1,000 at current market price immediately. This gets him skin in the game, roughly 6 shares at $162, and removes the paralysis of waiting for a perfect entry that may never come. Hold $1,000 in cash with a price alert set at 145150. If the anti-flipping window creates a temporary dip around June 27th, he deploys the second tranche at a potentially better price. If no dip comes, he reassesses in mid-July. Allocate the remaining $1,000 to a space-focused ETF, like ARKS. This gives him exposure to the broader space sector, diversifying beyond single stock risk while still benefiting if the space industry overall grows. Expected outcome under this approach: Marcus owns roughly 6 shares immediately. If a dip materializes, he adds 6 to 7 more shares at a lower average cost. His ETF holding provides diversification. His blended cost basis depends on actual entry prices. The key principle here isn't picking a perfect strategy, it's removing the paralysis of trying to time things perfectly and building a position systematically across entry points and methods. Now meet Sophia, 27 years old, earns $58,000 annually, has $600 available for SpaceX. She wants to participate, but feels like her capital is too small to matter. Again, hypothetical educational example, not personalized advice. With $600 and SpaceX trading around $160, Sophia can't buy 4 full shares, but she has excellent options thanks to fractional share investing. One approach: invest $300 immediately via fractional shares through Fidelity or Robinhood. This gets her roughly 1.87 shares at current prices with immediate ownership. Dollar cost average: the remaining $300. $50 per week for 6 weeks starting around June 27th. Investing through the anti-flipping window and potential index inclusion period. She's not trying to time the perfect bottom. She's systematically accumulating. Alternative approach: put the full $600 into a space ETF today. She gets immediate diversified exposure, including eventual SpaceX holdings, plus other space companies, with less single stock risk. My educational suggestion for someone in Sophia's situation: a split approach often reduces regret. Half deployed now for immediate participation, half deployed gradually for systematic accumulation. But the right choice depends on her personal goals and risk tolerance. The key message for Sophia and anyone with limited capital: the amount doesn't determine whether this is worth doing. Building the habit of investing consistently, learning how markets work, and participating in companies you believe in. Those things compound over time regardless of starting size. Before you make any investment decision, I want to spend real time on the risks. Not as a legal formality, but because I genuinely want you to go into this with eyes open. Warning 1. Short-term volatility is likely. The stock rose roughly 20% on day 1. Stocks that move that sharply in one direction can reverse just as sharply. A 15-20 pullback from recent highs in the coming weeks would be completely normal IPO behavior. Don't be shocked if it happens. Warning 2. The valuation is enormous and carries real execution risk. At over $2 trillion, SpaceX is valued higher than the GDP of most countries on Earth. That valuation prices in years of flawless execution on orbital AI infrastructure, business model that's still early stage and unproven at scale. One major setback could significantly impact the stock price. Warning 3. Only invest money you can genuinely afford to lose entirely. Not rent money. Not your emergency fund. Not money you need within the next 2 years. This is non-negotiable, regardless of how confident you feel about the company. Warning 4. Concentration risk is real. If SpaceX becomes a large percentage of your total investment portfolio, you're taking on enormous single company risk. Even if you have high conviction in Elon Musk and the SpaceX team, Concentration at this level can be dangerous. Diversification exists for a reason. Warning 5. FOMO is at its peak right now. Social media is full of people sharing their SpaceX positions and talking about going all in. That energy is not a reason to invest, it's actually a reason to be more careful and more disciplined about your process. Decisions made in the heat of hype rarely turn out well. Warning 6. Lockup expirations are coming. Employee and insider shares are typically subject to lockup periods, often 6 to 12 months after IPO, before they can be sold. When those lockups expire, millions of additional shares may hit the market. That selling pressure can weigh on the stock price. Watch for lockup expiration dates. Warning 7. The orbital AI infrastructure story, while compelling, hasn't generated meaningful revenue yet. You're investing in future potential based on a thesis, not current proven cash flows from that business line. That's inherently speculative, and you should size your position accordingly. Here's a practical framework for the next 15 days as the market continues to digest this IPO. This is educational guidance, adapt it to your own situation. Days 1-3 right now. Determine your total investment amount and which method or combination of methods fits your situation. Under $500, fractional shares or a space ETF. 5002-000. Consider splitting between immediate purchase and strategic waiting. Over $2,000, more flexibility to combine methods with diversification. Days 1-3. If you don't have a funded brokerage account, open one now and transfer cash. Settlement takes a few days at most brokerages. Having funds ready before your target date matters. Days 4-15 June 16th to 27th. If buying immediately, execute your first position in this window. If waiting for a potential dip, set price alerts and monitor without obsessing. Set the alerts, then step back and live your life. June 27th specifically, watch for potential increased selling activity as the anti-flipping window closes for early IPO holders. If you're targeting a dip entry, this is your highest probability window, but remember, it may not materialize. Days 16-30 late June to mid-July. Watch for index inclusion announcements. FTSE Russell inclusion may come first. Nasdaq 100 eligibility comes after more trading days. Institutional buying pressure from index inclusion could provide meaningful price support. Throughout this period, if you're dollar cost averaging, execute your regular purchases on schedule regardless of daily price movements. The whole point of DCA is removing emotion from the timing equation. Once you own shares, write down your investment thesis and your time horizon today. 3 years, 5 years, 10 years? This document will save you from panic selling the next time the stock drops 15% on a bad news day, because that day will come. Here's something that doesn't get enough attention. The SpaceX IPO didn't just create one new publicly traded company, it repriced the entire space industry overnight. Other space and aerospace adjacent companies saw significant moves on SpaceX's IPO day. According to market reports, SpaceX going public gives analysts and investors a major public comparable for valuing the entire sector, something that simply didn't exist before. For some investors, particularly those with smaller capital, the best opportunity might not be SpaceX directly. It might be smaller space companies that are now easier to value with SpaceX as a public benchmark, and that may have more room to grow from their current valuations. If you believe specifically in SpaceX's technology, moat, their track record of execution, the AI infrastructure vision, and the Starship program, direct ownership through any of the methods we covered makes sense. If you're less certain but excited about the space industry broadly, ETFs may give you better risk-adjusted exposure. The genuinely remarkable thing about investing in 2026 is accessibility. You can own a fractional stake in a $2 trillion company for $5. That kind of access to institutional-grade assets simply didn't exist for most people a generation ago. That matters. The SpaceX IPO just happened. It's a significant moment in financial and aerospace history. And unlike many historic moments, you still have the opportunity to participate at any capital level. We covered 6 different pathways from $5 to more advanced strategies. You understand the critical dates over the next 15 days. You've seen realistic case studies of how to think about execution at different budget levels. And you heard the real risks clearly. What you do with this information is entirely your decision. Make it deliberately. Make it based on your own financial situation, your own risk tolerance, and your own time horizon, not based on social media hype or fear of missing out. If this breakdown was useful to you, please hit the like button. It genuinely helps this channel reach more people who are trying to make sense of big market moments like this one. Subscribe to Prosperity Levels, because next week, we're covering the ripple effects across the entire space sector, which companies may benefit most from SpaceX going public, and specific names worth researching beyond SPCX. One final reminder. Everything in this video is for educational purposes only. This is not financial advice. I am not your financial advisor. Please consult a licensed professional before making investment decisions. Invest responsibly, invest within your means, and invest for the long term. SpaceX is public. The information is in your hands. Execute your plan wisely.